In January 2026, CNBC called XRP the trade of the year. Same network, same anchors who spent the last decade telling you that cryptocurrency was digital tulip bulbs for idiots. Same Jim Cramer who said Bitcoin was fake money and you'd have to be stupid to own it. Now they're breathless. XRP is up 400%. It's the future of cross-border payments. Institutional adoption is here. But here's what nobody's telling you. In 2013, Ripple created 100 billion XRP tokens out of thin air. The founders kept 30 billion for themselves. Then they spent a decade selling partnerships with banks that never actually used the token. And now, after the SEC dropped its lawsuit, after Trump announced a crypto reserve, after BlackRock filed for an XRP ETF, suddenly this is the smart money play. You're supposed to believe this happened by accident. I'm going to show you exactly how they ran this playbook, how the same institutions that called crypto a scam spent 15 years building the infrastructure to sell it back to you, how the con isn't cryptocurrency itself, it's the bait and switch between decentralization and institutional capture, and why understanding this distinction is the only thing standing between you and making the same mistake twice. By the way, I built something called the Early Retirement Calculator because every free tool online uses fairy tale math. Mine runs on the same institutional formulas Vanguard and BlackRock actually use. It accounts for inflation, taxes, realistic yield, and the psychological trap of inconsistent contributions. Hundreds of people have used it. It's free. I'll ask for your email so I don't store your financial data, just send you the report. You can play with the numbers and see what happens if you get 1% more yield or add $500 a month. Here's the central metaphor you need to understand. There's a nightclub in every major city. Beautiful people, velvet rope, $16 cocktails. The bouncer stands outside and tells the line that the club is at capacity, it's exclusive, it's not for everyone. Meanwhile, the owner is inside calling every promoter in town, begging them to bring warm bodies because the place is empty and the liquor license renewal is coming up. The bouncer works for the owner. The rejection is marketing. By the time they open the rope, you're so grateful to get in that you don't notice you're paying double for well vodka in a half-empty room. That's the crypto playbook. And it starts in 2008. Satoshi Nakamoto releases Bitcoin on January 3rd, 2009. The Genesis block has a message embedded in the code. Quote, "Chancellor on brink of second bailout for banks." This wasn't subtle. Bitcoin was a direct response to the financial crisis, to Lehman Brothers collapsing, to AIG getting $85 billion in taxpayer money, to Ben Bernanke printing money and calling it quantitative easing while your savings account paid 0.1% interest. The promise was simple: 21 million coins. No central bank, no Bernanke in a suit deciding your purchasing power. You could hold it yourself, nobody could print more. It was digital gold for people who watched the government bail out the banks and realized the game was rigged. And Wall Street hated it. I mean, visceral, on-air hatred. Jamie Dimon called it a fraud in 2017. Worse than tulip bulbs. He said he'd fire any trader at JP Morgan who touched it. Warren Buffett called it rat poison squared. Charlie Munger said it was disgusting and contrary to the interests of civilization. The New York Times ran op-eds about how Bitcoin was for criminals and libertarian weirdos. CNBC brought on skeptics who said it would go to zero. Here's what they didn't tell you. While Dimon was calling it fraud, JP Morgan was filing blockchain patents. Fidelity launched a crypto custody service in 2018. Goldman Sachs was clearing Bitcoin futures. BlackRock, the largest asset manager in the world, was quietly meeting with Coinbase about institutional infrastructure. They were building the on-ramp, the exchanges, the custody solutions, the ETF wrappers, the tax reporting systems. The same banks that needed bailouts in 2008 were creating the products to sell you the thing that was invented because they needed bailouts in 2008. And then the switch flipped. January 2024, the SEC approves spot Bitcoin ETFs. BlackRock launches iShares Bitcoin Trust. In 10 months, it pulls in $35 billion. becomes the fastest growing ETF in history. Suddenly, Jamie Dimon isn't calling it fraud anymore. He's saying blockchain has real use cases. Fidelity is offering Bitcoin in 401ks. Goldman has a digital assets platform. And CNBC is running segments on whether you should have 5% or 10% crypto exposure. What happened? Did Bitcoin change? No. The code is the same. The 21 million cap is the same. The decentralization is the same. What changed is that Wall Street built the toll booth. They can't control Bitcoin, but they can control the on-ramp. You want exposure? Buy our ETF. We'll charge you 0.25% annually. You want custody? Use our service. You want to trade? Our clearing fees apply. They turned the thing that was built to opt out of the financial system into a product inside the financial system. And now the second part of the playbook kicks in. Enter XRP. Most people don't know this, but XRP launched in 2012, a year before Ethereum. It was created by a company called Ripple Labs. And unlike Bitcoin, which was designed to replace banks, XRP was designed to help them. The pitch was elegant. Banks move trillions of dollars across borders using a system called SWIFT that was built in the 70s. It's slow, it's expensive, it takes 3 days to settle. Ripple said, we can do this in 4 seconds using blockchain and it'll cost fractions of a penny. Cool idea. One problem. XRP, the token, wasn't actually necessary for the system to work. Ripple had a product called X-Current that banks could use without ever touching XRP, and that's what they did. Hundreds of banks signed partnerships with Ripple, Santander, American Express, SBI Holdings in Japan, press releases everywhere. But when you dug into the details, they were using X-Current, not XRP. The token price didn't matter to the banks, but it mattered to Ripple. Because remember, they pre-mined 100 billion XRP and kept 30 billion. If XRP went from 1 cent to $1, that's $30 billion in value for the founders. So they had every incentive to hype the token. And they did. They sold billions of dollars worth to retail investors who thought they were getting in early on the next Bitcoin. The SEC noticed. In December 2020, they sued Ripple, said XRP was an unregistered security. That Ripple raised $1.3 billion, selling something that should have been registered like a stock. The case dragged on for years. XRP got delisted from major exchanges. The price crashed. Everyone said it was dead. And then Trump won in 2024. First move, Gary Gensler, the SEC chair who brought the Ripple lawsuit, resigns. Second move, Trump announces he wants America to be the crypto capital of the world. Third move, the SEC drops major parts of the case against Ripple. Fourth move, institutional money floods back in. Suddenly, XRP is up 400%. It's the third largest crypto by market cap. And the same media figures who called it a scam are now calling it the trade of the year. Here's the pattern you need to see. It's not about the technology. It's about control. Bitcoin was too decentralized, too hard to control, but it was popular. So Wall Street built the infrastructure to financialize it, turn it into an ETF, make it safe, approved, regulated, and once that worked, they needed a version they could control more directly. Enter XRP, a token where insiders hold 30%, where the company can influence development, where institutional adoption doesn't threaten the system, it reinforces it. Let me give you a concrete example of how this plays out in dollars. Meet David, 42 years old, lives in Ohio, works in logistics. He's got $75,000 in his 401k. It's been sitting in a target date fund returning 7% a year. He keeps reading about crypto. His brother-in-law made money on Bitcoin. He sees the news about institutional adoption. He's thinking, maybe I should get some exposure. So he looks at his options. He could buy Bitcoin directly, set up a Coinbase account, figure out self-custody. That sounds complicated. Or he could buy the BlackRock Bitcoin ETF in his Fidelity account. Same interface he already uses, FDIC, insured custodian. He buys $10,000 worth, feels smart, diversified. Here's what just happened. BlackRock is charging him 0.25% per year. That's $25 annually on his $10,000 position. Fidelity might charge a transaction fee, let's say $10. The ETF doesn't actually hold Bitcoin directly in some cases, it holds futures, which have a roll cost. That's another hidden fee. Meanwhile, if he'd bought Bitcoin directly, he'd pay a one-time fee of maybe 1%, $100. Then he owns it. No annual fees, no middleman. Over 10 years, if Bitcoin goes up, David makes money either way. But BlackRock and Fidelity make money whether Bitcoin goes up or down. They get paid on assets under management. David took the risk. They took the toll. Now scale that across $35 billion in the iShares Bitcoin Trust. That's $87.5 million a year in fees. Every year, whether Bitcoin goes to 1 million or crashes to 0. They told you it was a scam while they built the toll booth. But here's where it gets really interesting. The XRP surge in 2026 isn't random. It's the next phase. Bitcoin was the proof of concept, showed that retail investors would buy crypto, showed that institutions could financialize it. Now they need a version they can control. XRP is perfect. It's fast. It's cheap to transact. And it's designed to work with banks, not replace them. So what's the end game? Treasury Secretary at the time floats the idea of using stablecoins to maintain dollar dominance. Not Bitcoin, stablecoins. Digital dollars backed by US treasuries. Ripple is perfectly positioned for this. They've already got relationships with central banks. They've already got a token that moves fast and cheap. If the US government decides to create a central bank digital currency infrastructure, guess who's got a head start? This is the nightclub playbook. They kept you outside, called it a scam, built the infrastructure inside, then opened the rope once everything was in place. And now you're paying a premium to get into a game where the house already owns 30% of the chips. Now, I know what you're thinking. Okay, so they're hypocrites. They trashed it and then sold it. But does that mean I shouldn't own any crypto? No, that's not what I'm saying. Here's the thing. Just because Wall Street financialized it doesn't mean the underlying idea is wrong. Bitcoin is still scarce. There are still only 21 million. The code hasn't changed. And if you believe that central banks will keep printing money, which they will, because that's the only move they have, then hard assets with provable scarcity have value. But you need to understand what you're buying and why. If you're buying the BlackRock ETF because CNBC told you to, you're the exit liquidity. You're the person who shows up to the nightclub at midnight and pays full price. If you're buying Bitcoin because you understand monetary debasement and you're willing to self-custody and hold for 10 years, that's different. That's a bet on the failure of fiat currency. And XRP? Look, I'm not going to tell you it's going to 0. Maybe it rips to $5. Maybe Ripple becomes the backbone of central bank digital currencies. But understand what you're buying. You're not buying decentralization. You're buying a bet that institutions will adopt a token where insiders control 30% of the supply. That's not opting out of the system. That's buying equity in the next iteration of the system. Let me tell you a story. Back in the 90s, there was this thing called the dot-com boom. Everyone said the internet was going to change everything. They were right. It did. But most of the companies went to zero. Pets.com, Webvan, eToys, billions of dollars evaporated. The people who made money weren't the ones chasing every hot IPO. They were the ones who bought Amazon at $6 and held it for 20 years. Or the ones who avoided the hype entirely and just kept buying index funds. Crypto is the same pattern. The technology is real. Blockchain will matter. But most of these tokens will go to zero. The people making money right now aren't retail investors buying XRP at $2. It's the Ripple founders who minted 100 billion tokens for free. It's BlackRock collecting fees on assets under management. It's the exchanges collecting transaction fees. I've been running my own business for over a decade. I've sat in rooms with accountants and fiscal lawyers. I've learned how money actually moves. And the number one rule is this: follow the incentives. When someone is selling you something, ask who profits if you buy it. When CNBC tells you XRP is the trade of the year, ask yourself, who benefits from retail investors piling in at a 400% markup. Here's my actual advice. 3 things. 1, if you want crypto exposure, understand what you're buying. Bitcoin is a bet against central banks. Ethereum is a bet on decentralized applications. XRP is a bet on institutional adoption of a centralized token. Those are different bets with different risk profiles. Don't buy something because it's up 400%. Buy it because you understand the thesis. 2, don't use crypto as a replacement for a real investment strategy. I've got multiple hundreds of thousands of dollars invested. The core is boring. Index funds, real estate, bonds. I have crypto exposure, but it's a single-digit percentage of my portfolio. It's asymmetric. Small position, big potential upside. But if it goes to 0, I'm fine. If you're putting your emergency fund into XRP because someone on Twitter said it's going to $10, you've already lost. 3, self-custody or accept the risk. If you're buying the ETF, you don't own Bitcoin. You own a claim on Bitcoin that BlackRock holds. If there's a liquidity crisis, good luck getting it out. The whole point of crypto was to opt out of trusting institutions. If you're buying it through the same institutions that needed a bailout, you're missing the point. The lie isn't that crypto is a scam. The lie is that the people calling it a scam actually believed it. They didn't. They were buying time, building infrastructure, filing patents, creating products. And now that the toll booth is operational, they've opened the gates and invited you in. You know what's wild? Lazy investing built more fortune than crypto memes. The people who got rich from Bitcoin weren't day trading. They bought it at $300 and forgot about it for 10 years. The people getting rich from XRP right now are the founders who minted it for free in 2012. Everyone else is just hoping they're early enough to catch the wave before it crashes. So yeah, they lied to you about crypto. But the lie wasn't that it's worthless. The lie was that they weren't paying attention. They were. They just didn't want you in the game until they controlled the board. Now you know. Do with that what you will.